Good evening, everyone. Time for another silver update. This is the hourly chart of silver provided by netdania.com. You can click on the link below. And I've drawn in a rough trend channel, and you can see here that we're still in the trend channel. We had a breakout of it, and then we had a consolidation into what I described as this pennant formation, and then a breakout. Then of course we had the reaction to the Fed and their minions attacking here right at the top of the trend channel here, and then we bounced up and now we're still rising. So we're testing along the bottom of this trend channel, and that makes it still a valid pennant. It's just extended out now. You can see that the bottom of the pennant right here is at about 2060 or so, and that's still only about a 1/3 retracement of this move here. So it's still a valid pennant, and we're going to see here a resolution fairly soon. If we do get a breakdown of this trend channel, then we may see a move down like this. We don't know what the move is going to be. It may be something similar to this move. You can see that once this breakout, it appeared to be a breakout into a new pennant, and then it crashed, completely failed, went all the way into the trend channel, tested the bottom, and now we're rising. If this breaks out, it's possible that we will get a violation just like this. Now, I'm not certain that that's going to happen, but we know we'll have a resolution fairly soon. If we continue to rise, then we can see that eventually we're going to challenge this support line here, which was the basis of this original breakout, and we're going to retest that. So we're going to know in the next few days which of these it's going to be, and I expect a fairly decent move one way or the other when either this lower trend channel is broken or we get a breakout above this resistance line again. Now I want to look at the latest from Eric Sprott. This is ongoing rot in the economy, and I'm going to read some of this, not all of it. While most have been conveniently blaming the tepid first quarter negative 2.9% GDP growth figure on the weather, we believe that it's just another symptom of a much deeper malaise. As we have argued many times before, the U.S. economy has been on life support graciously provided by central planners. However hard they try, they will soon realize that no amount of money printing can cleanse the rot of the U.S. economy. Most tellingly, in a recent interview with Reuters, Bill Simon, Walmart's chief executive officer for the U.S., said, "We've reached a point where it's not getting any better, but it's not getting any worse, at least for the middle class and down." Indeed, if one looks past the headline figures, things are not really getting better. As shown in Figure 1, real disposable income per capita in the U.S. has increased only modestly since the Great Recession. We're going to look at that a little bit here, this Great Recession that everybody talks about. However, all this increase is due to government transfers and not from an improvement in the real economy. If we exclude those transfers from the numbers, the disposable income per capita is actually lower than it was at the end of 2005 and has been painfully flat since 2011. Also, those numbers assume that the headline CPI accurately represents people's purchasing power. So here's the chart, real disposable income per capita, and you can see this lower line here. This is excluding government transfers. So when we don't look at the welfare state, then we can see that the real economy underneath it is has not recovered. It's just going sideways. First of all, there is income inequality. Those in the top 20% have seen their incomes increase, while those in the bottom 40% have stagnated or even decreased. Figure 2 shows the average after-tax income of U.S. households by quintiles as measured by the Bureau of Labor Statistics. Now I'm going to jump down to the information about incomes. The second and third panels of Figure 3 show average annual expenses in dollars as well as in percent of after-tax income. We also show a breakdown of spending for categories that we consider non-discretionary, in the sense that they are unavoidable expenses such as food, shelter, utilities, healthcare, and transportation. Perhaps the most striking but not that surprising finding from the table is the fact that 40% of U.S. households spend about 40% more than they make. 138% and 145% in 2005 and 2012, respectively. In case you wonder how a household can spend more than it earns, there are many ways, such as borrowing, selling assets, assistance from family, etc. While incomes increased only 8%, total expenses increased 14%, driven by very large increases in shelter and healthcare spending. Additionally, an ever-increasing proportion of people's after-tax income goes towards what we will call non-discretionary spending, as shown at the bottom in Figure 3. In 2005, those households used to spend 97% of their income for basic necessities, while in 2012 has increased to 104%. 5 years into this so-called economic recovery, and on average 40% of the poorest U.S. households still spend more money than they earn, including government transfers for basic necessities. Now think about that. That's an amazing statement. And that just goes to show you what we've been pointing out for the longest time, that this recovery that they talk about, this is a recovery for Wall Street. It's not a recovery for Main Street. We believe that there are two main reasons for this. The first one has to do with income inequality. As we have shown, incomes have been almost constant since 2005, with most of the increase driven by unsustainable government assistance. Furthermore, prices for basic necessities, which constitute the entirety of these households' budgets, have been increasing at a steady pace. Figure 4 shows the reported price over the past 7 years for energy, food, commodities, and rents against the official headline CPI. And that's this chart here. How can we have an economic recovery when there is barely any discretionary disposable income for 40% of the population? As we have shown above, those that have seen their incomes grow and not the ones most likely to spend are not the most ones likely to spend, while the bottom 40% of households still rely heavily on government assistance, have had stagnant incomes, and have been faced with increasing inflation for non-discretionary goods that constitute a very large share of their incomes. There is clearly no recovery. So, excellent from Eric Sprott, as always. Now I wanted to take you over to the Wikipedia entry for the Great Recession. The Great Recession, also referred to as the Second Great Depression, that's citing one author, Lesser Depression, Long Recession, or the Global Recession of 2009, was a global economic decline in the late 2000s decade. The effects of this economic downturn are having a continued influence in 2014. The exact start and end point for the recession at the national level, however, greatly varied from country to country, and some countries did not experience any recession at all. Countries such as China, India, Australia, by the way, there's more than half the world's population right there. Countries such as China, well, not more than half, I'm sorry, almost half. Countries such as China, India, Australia, South Korea, and Indonesia did not have a recession. Many countries in Europe had a recession, second recession, starting on average about 3 years after the first one. Some, Germany, Switzerland, Sweden, UK, did not have a second recession. Most countries outside Europe did not have a second recession. So, very interesting. You hear the term the Great Recession, or sometimes depression. And one that you hear all the time now is recovery, which is kind of strange. As we'll see here when we look at the Fred database information, that the shaded areas are recessions. So the question is if the recession ended, and the date we have is June 2009, so that's over 5 years ago. If the recession ended over 5 years ago, why are we still talking about a recovery? So all this stuff is strange. It doesn't make a lot of sense. But I wanted to take you to a couple of these market tools, and they're very valuable. I wanted to start out with trading economics, and what I did here is just to show you, you could go down and pick a country out of this list. I went and picked a country and I chose South Korea, and then I went down under money and I chose interest rate. Then what I did was I went to the graph comparisons and chose under countries, United States, and interest rate. Now you can see here from the chart that South Korea, which if you remember what we just read, was one of those that did not experience the Great Recession. You can see their interest rate dropped from about 5 all the way down to 2 at the beginning of this, and you can see they flatlined at around 2. But then in 2010, you can see they started to rally in interest rates. It got almost up to 3.5%, came down a bit. Now they've stabilized at 2.5%. That's going to be this left bar here. Now, the U.S., on the other hand, you can see that our interest rates dropped down to near 0 and have never recovered. So there's a perfect example of a flatline situation. Why is it that that's happened in the United States and hasn't happened in South Korea? Is there something wrong with our central planners? Are they not as good as their central planners? So that's the trading economics website and the tools, and there's a tremendous number of charts there. Now the other one I wanted to take you to is the Fred. These are the Fred charts that you see all the time, and I'm going to have you go back so you can see how I got here, because there's a lot here. So what you do is you go to this site, research.stlouisfed.org. This is the Federal Reserve Bank of St. Louis. What you click on is Data Tools and create your own graphs. Now what I did is, instead of typing in the keyword, I just hit the Browse button, and you can see all the categories that you have here, a tremendous amount. And if you wanted to look for some shocking charts, I'm sure that you could find some going through here. I'm going to look at just one shocking chart, and that's going to be under interest rates. You can see there's 722, and I'm going to pick the Treasury bill. This is the monthly. What you do is you click that, and now you click this Add Series button. You get your chart, and what's neat about this is that you can use these tools down here. If you click on Export, you can see you can put it into a PDF, PNG, a JPEG. So we'll put it into a JPEG, and now here we have our image. So a nice image that if you want to use in your articles, blogs, etc. I don't believe there's any copyright problems with this. After all, it is the Federal Reserve. I guess maybe if they're a private company they could sue you, but I think that you're able to use these. So let's look at this chart here. You can see this is the big picture of the Treasury bill, the 3-month Treasury bill. You can see that in the 1980s it actually got above 15% on the 3-month T-bill. You can see that, as I pointed out before, the shaded areas. So you can see when we look at the shaded areas, it's not really clear here why this is the Great Recession. You can see that there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 recessions that go back after we had the Great Depression. We've had 13 recessions here. And I'm not really sure why this one is supposed to be greater than the others. If you look at the size, it doesn't seem to be. If you look at the double dip recession that we had in 1980, this actually started in 1980 and appears to go through 1983, so about 3 years there officially, although there was a break out of it. The other thing to note here that kind of stands out is you can see the drop in interest rates in the recession, and then you get a bounce once the recession's over. Now that pattern holds here. You can see in the 50s and 60s, and even this one in the 70s, we had a bounce, but then you started to get this pattern here where we get out of the recession and rates continue dropping, and then they bottom and then they rally. You can see that again here. You can see it again here, and it's here and here. And you can see that it took a while for interest rates to bottom out and then begin to rally again in the 1990 recession. In the Bush recession of 2000, you can see it took a while. They had to keep them low, and then they came back up. But now let's look at the latest recession that we have here. And to do that, we'll go ahead and just pull back to the 10-year. Here it is. So you can see that is an absolute flat line of the T-bill interest rate. Remember, this was as over 15% during the 80s. You can see now it is going between 0.1 and 0.2 for over 5 years. So what is going on? Is this a recovery? Are we still in the recession? Is it a depression? I don't think they're going to tell us the truth one way or the other, but it seems that the Fed is in a box. I encourage you to play with these, especially this Fred. I'm going to be spending a lot more time on this because I think there's going to be a lot of information that can be teased out of this with the thousands of charts that are available here. This is one good thing, I'll say, that the Federal Reserve has done. So back to the silver chart, you can see here that we're still traveling within this trend channel, and I expect within the next few days we're going to get a resolution of whether this lower end of the trend channel breaks and we get some kind of significant down move, and this pennant fails, this pennant formation fails, or we get a test of this overhead resistance and we go back up again and test this area. And we'll talk to you next time.